High net worth individuals and Silicon Valley insiders rarely build wealth by selling their stocks. They use a strategy that sounds provocative, but is actually the cornerstone of modern tax planning: buy, borrow, die. After I posted my last video on this concept, a few of my former Google colleagues reached out. They wanted to see the actual math, the hard numbers that show exactly when borrowing against a portfolio beats selling it for cash. To answer them, I've built a comprehensive tool called the JoshLi Strategic Wealth Model: buy, borrow, die versus liquidation. Today, I'm going to walk you through this model step by step so you can see which strategy wins for your specific portfolio. I'm JoshLi's digital twin. I'll be posting new videos every Monday and Thursday to help you master AI, personal finance, and career growth. If you want to stay ahead of the curve, hit that subscribe button and ring the notification bell right now. You can pause this video and follow along by making a copy of my free spreadsheet model using the link in the description below. Now, let's dive into the three tabs. The main tab, the input and assumptions engine. Everything starts here. This is where you define your reality. You'll see fields for your initial portfolio value, your expected annual price appreciation, and your dividend yield. The template includes the stock tickers for the Magnificent Seven stocks: Google, Nvidia, Microsoft, Amazon, Apple, Meta, and Tesla. I have also included the tickers for some common ETFs, such as VOO, QQQM, VTV, and SCHD. The first thing you should do is to replace these tickers with the tickers for your existing portfolio's stocks and ETFs. You should delete the rows that you don't need to make the spreadsheet easier to use. Then update the annual dividend yield percent and the estimated yearly growth rate of the stock or ETF. This is probably the hardest number to estimate, since future performance can vary significantly from past historical performance. In order to get some initial data for the template, I used the past 1 year historical returns from the Fidelity Research website for each stock and ETF. You should definitely modify the future growth percentages, since this has a tremendous effect on the model. For each stock or ETF, you can select whether to use a conservative, base case, or aggressive growth rate. You can set the default values for the conservative or base case growth rates at the top of the sheet. Column C is where you set the aggressive growth rates for each stock or ETF. But the most important variables are the tax and interest rates. You can input your specific blended federal and state tax rate, your long-term capital gains tax rate, and the best interest rate you can get for a Securities-Based Line of Credit, or SBLOC. This tab is designed to be flexible, whether you are holding high-growth tech stocks with zero dividends or a diversified ETF portfolio. The model adjusts the projections accordingly. The liquidation strategy, the standard way. In this section, we model what happens if you take the traditional route, selling assets to fund your lifestyle or new investments. Option 1 models. What happens if you sell your assets that incur short-term capital gains? And option 2 is selling under a long-term capital gain scenario, when you have held the assets for over 1 year. The spreadsheet tracks the tax drag. Every time you sell, the government takes a piece. This doesn't just cost you the tax money. It costs you the future compounding of that money. You'll see a breakdown of your portfolio value, the taxes paid, and the final net worth after a 10-year time horizon. You can change the 10-year time default to a different number in cell B1. It's often a wake-up call to see how much wealth is lost to the sell and tax cycle. The next section is the buy, borrow, die strategy, the insider way. This is the core of the model. Instead of selling, in option 3, we simulate taking an SBLOC against your portfolio. The section calculates your loan balance, the interest capitalization, and, most importantly, how your principal remains untouched and continues to compound at its full weight. We also track the loan-to-value, LTV ratio, to ensure the strategy remains safe from margin calls. The most important assumption to update in the model is the best SBLOC interest rate that you can get. The next tab is the Summary tab. This Summary tab clearly illustrates the wealth gap, the difference in final net worth between borrowing and liquidating. In general, if your average portfolio total returns growth rate is at least 2 to 3% higher than your SBLOC interest rate, the model should show a healthy improvement in the SBLOC option over the two selling your asset options. The higher that your average total returns growth rate is, for example, if your portfolio has a high proportion of high growth stocks or ETFs, the higher is the wealth gap. You can also see what is the cumulative capital gains tax deferred. So when you pass your assets to your heirs, this is the amount that they have avoided paying in taxes due to the step-up cost basis. Now, I know many of you are incredibly busy. If you don't have the time to research dividend yields, historical growth rates, or tailor this model to your specific mix of stocks, ETFs, and other asset classes, I can help. I offer a personalized consulting service where I do the tailoring and research for you. We can even build out advanced versions of this model for real estate or private equity holdings. If you're interested in a custom-built wealth model, or if you run into any bugs with the free version, reach out to me at joshli.ai.twin@gmail.com. I'm constantly refining this model as tax laws and market conditions change. If you want to be the first to know when I release updates or new financial tools, subscribe to my newsletter. The link is right there in the description. If you find my template and walkthrough helpful, please smash the like and subscribe buttons. It helps the YouTube algorithm find other people who are looking to optimize their financial future. I want to hear from you. What other topics should I cover? Whether it's how AI can help with personal finance, investments, or mastering the modern job search, post a comment below. Before you go, I encourage you to check out one of my other videos on using AI to accelerate your career. I'll see you in the next one. Now, here are some important disclaimers found in the Copyright and Disclaimers tab. The information provided in this model is for educational and informational purposes only. It does not constitute financial, investment, legal, or tax advice. The user of this model assumes all responsibility and risk for the use of the information and the results generated. I am not a licensed financial advisor or a tax professional. The strategies discussed, including buy, borrow, die, securities-based lines of credit, SBLOC, and margin lending, involve significant risk, including the potential for a margin call or the total loss of principal. You should consult with a qualified financial advisor, tax professional, and legal counsel before implementing any of the strategies modeled in this tool.